it makes sense to hold a little bit of gold and silver in your portfolio to offset that risk and give yourself away. Worst case scenario, if we have bank closures and the new system's not working, there are glitches, to go down and trade for some bread and eggs if you absolutely have to. Hey everybody, this is Rob Kientz of goldsilverpros.com reporting for jmbullion.com. For those of you interested in gold and silver bullion, I fully recommend that you head over to jmbullion.com and take a look at the products that they have in store for you. JM Bullion is one of the largest dealers here in the United States, has an excellent reputation, and happens to be based in my backyard in the Dallas-Fort Worth area where I live here in the great state of Texas. As you guys know, you follow my blog over at Gold Silver Pros. I want to chat a little bit today about what's going on in the crypto space. This will be the first piece that I'm talking about, the crypto space, Bitcoin. We're going to be focusing on FTX fiasco and what happened to the exchange, and how I think that's going to lead into a lot of regulation over the private cryptos, and how the central banks are using the private cryptos basically to develop their own version. Right now, the New York is testing out the digital dollar and its interoperability with other sovereign digital currencies as well, and something called Project Cedar. So we're going to talk about that and kind of outline the roadmap for you on what's coming as far as the digital currencies go, both the public government kind and also the private ones. So without further ado, let's jump right into it. And I'm going to start off with basically just a series of articles talking about what's going on in the space. This one's from BBC News. They're talking about FTX. And of course, this is Sam Bankman-Fried, who's the CEO. And it just goes on to talk about what happened. Essentially, what they did was they set up this exchange. An exchange in the cryptocurrency world is where you take one crypto and exchange for another, or exchange crypto for cash, or various products. And there are a lot of different cryptos out there. So the exchanges are basically a way to facilitate crypto trade from somebody's private wallet or public wallet, from one person to another, or from institutions to another. And these exchanges really are there to facilitate the trade of these cryptos. And of course, they make money from that because they're setting up the infrastructure and taking fees for doing all this. It's not unlike a bank, essentially, in the current system. Well, FTX had started a research arm called Alameda and did some highly risky speculative bets on other cryptos technologies, other cryptos, and other investments. And they're ended up going to lose. They're basically the $32 billion company that Sam Bankman-Fried had developed is basically falling apart. Now, I did warn that there were issues with the crypto space the last few years. I have been in technology for about 25 years. I'm looking at it with a technologist lens. And I'm also looking at it from a monetary historian lens, because I also have covered monetary history for thousands of years in my writings over the last 13 years. And I noticed some problems. So way back in 2018, I wrote this article, January 11th, 2018, almost 5 years ago, for Seeking Alpha, where I talked about the issues with the cryptocurrencies. And without going through the full article, I just want to point out that I've talked about how digital cash was something that the founders of the internet originally envisioned, and how they built in some infrastructure, but how digital cash and micropayments needed to be built on later. The technology didn't exist. And now we have the cryptocurrencies and various other forms of electronic money, I think, are being developed. And that's really fulfilling the original promise of commerce on the internet, or value exchange on the internet, that the founders of the internet wanted, but just didn't have the technology to do back then. Well, one of the things I talked about in this article were some of the challenges. And there's a good article here from Forbes talking about 8 reasons to be skeptical about blockchain, written by Jason Bloomberg for Forbes.com back in 2017. And he was talking about some of the issues. And some of those issues basically I outline here. Most people have not adopted blockchain or cryptocurrencies as their actual money of choice. 85% of transactions all the way back in 2017, according to Ellery Davies, co-chairman of CRIPSA, were speculative. And as I look through research today, that number really hasn't changed. About 80 to 85% of transactions are speculative and not as a monetary exchange for a good or service. Blockchain has high transaction costs. And if you get into like Ethereum and those proof of stakes or other proof of work systems moving into proof of stake, one of the issues with like Ethereum was high gas fees or fees to transfer. Bitcoin has the same issue. There are some fees, but it's just the time to settle transactions. So that technology is not fully developed. You can actually use it just like you would use cash today, or even something like wire transfers. Transfers were slow. Blockchain technology is complicated. The network may collapse under additional weight. It can't handle transaction volume. One of the early Bitcoin developers, Mike Hearn, noted that Bitcoin has failed in its mission to be a truly independent distributed ledger system, is largely controlled by a handful of people. And he's talking about from a development perspective, meaning he essentially believes that there are people that do control development of Bitcoin. So even though it's decentralized from a node perspective, or a node is basically a node can be a confirming node where you're confirming transactions, or just a private, individual node. Those nodes are pinpoints along the spectrum of connected systems, facilitating Bitcoin essentially. While those could be decentralized by people implementing, the software used to run them is not centralized. And one of the former developers noted that. And that's where you can get control of how Bitcoin operates that may not align with the original vision of Satoshi, who developed it, whoever Satoshi ends up being. Hacking is common and millions have been lost. This is not a new problem. Power requirements and proof of work systems make them unsustainable over the long term, and other things like that. I wrote again about it, actually did a video about it all the way back in 2018, about 8 months later, where I was talking about the first time, or this time, that cryptocurrency had plunged way back then, and talking about some of the issues. And a lot of the cryptos fall together. One of the problems with investing in crypto, if one goes down, another does. And that's because a lot of them are sort of what I will call incestuously invested in one another. So you wonder how the cryptocurrency complex has gotten so much money to support the development so quickly. Well, one way that has happened is that they each invest in each other. And that's one of the things that FTX did, was it invested in some projects in the crypto space that didn't turn out. And so now investors have lost their money. And the crypto space is trying to finance itself by coins buying other coins, and people investing money from one crypto into another. And while some of that investment is probably legitimate in terms of building the crypto space, as we have problems in the crypto space, a lot of those funds are basically being destroyed, and it's caused a lot of investor losses. And that's normal when you have a new product that's highly complicated, like the blockchain and the cryptocurrencies riding on top of them are, and it requires a lot of work. And that era is here to stay. It's going to take a while for development of Bitcoin and all the supporting infrastructure basically to take place, where it becomes a viable alternative currency that people can actually trade. It's not there yet. I think what's going to happen, though, with the collapse of FTX is here comes the government going to regulate the holy heck out of the crypto space. And it means a lot of that regulation may thwart or slow down the development of the cryptos, things that actually need to be there to make it work. It will provide some government oversight, some auditing, and things like that that are going to address what's going on with the crypto space. But if they try to do it traditionally, like they've done across the rest of the financial markets, it's going to slow way the heck down what's going to go on in the crypto space, and it may stop some innovation in certain areas. We'll have to see how that pans out. It says here, according to CNBC, the Biden White House has just released its first ever framework on what crypto regulation in the U.S. should look like. It outlines the ways in which financial services industry should evolve to make it easier, but also issues a lot of new guidelines. What I take from this, if I translate this to English, is they want central banks to issue digital currencies. They don't want the private cryptos to operate on the same level, meaning being direct competitors. And if you look at what the White House said in their release on their website about a comprehensive framework for responsible development of digital assets, you can tell in here that the administration wants basically to promote a safe version of that, which is going to end up being the digital dollar issued by the Fed, which we'll talk about here in a moment when we get to the New York Fed's Innovation Center website and their project Cedar. But I think that basically, if you read between the lines and you look at what the government has said before and what's in here, they're basically, I think, in some ways going to demonize Bitcoin and the rest of the crypto space for the investment failures and for hacking and money laundering and security, while they implement their own centralized version of centralized version of a digital currency called the digital dollar, while the rest of the world does the same. I'll let you guys read this. I want to move on to the New York Innovation Center. This was set up for the purpose of delivering a central bank innovation execution capability, or in other words, developing the digital dollar for use in the real time, because the Fed knows what's going to happen to the fiat dollar after it starts to collapse. We've had de-dollarization. We've had about a 98% loss in the dollar since 1913. The Fed knows what's coming. They know it's the end of that era. We're in the last probably couple of years of it. And so they're developing their replacement for it. Problem, currency collapses. Solution, another version, electronic version of it by the same people, who collapsed the original one. Isn't it great? But that's what they're going to do. And on this website, you can look at Project Cedar and all the things that they're doing. Nice, cutesy looking little website, developed very well. But essentially, it's basically for the purposes of getting the central bank digital currencies developed so that they can push them out to the public when the existing dollar has issues. And believe me, they're going to do that. So here's a nice article on Project Cedar from the NewYorkFed.org's website on November 4th, 2022. And they're talking about how they're using this to, quote, create safe and efficient cross-border payments, which are critical to the functioning of the global economy, said Per von Zillowitz, director of the New York Innovation Center. Project Cedar Phase 1 revealed promising applications of blockchain technology and modernizing critical payments infrastructure. And our inaugural experiment provides a strategic launchpad for further research and development regarding the future money and payments from the U.S. perspective. In other words, what's going to replace the dollar? There were things that they focused on: faster payments, atomic settlement, and safer and accessible transactions. Atomic settlement basically is roping in smart contracts. A new concept here on this channel and for you guys: smart contracts are an electronic version of a contract that can be transmitted over computer systems very quickly, and also allows almost instantaneous validation of both payment and delivery of goods and services using digital infrastructure. So translated, the smart contract is a way to ensure that the payment made and the goods delivered are equal at the time the transaction is done. How does that work? Rob, how do you validate that lumber is the right quality, length, and type based upon a smart contract when lumber hasn't been shipped, overseas yet? Well, the smart contract will dictate how that lumber should look and feel and operate, and how it should come and what sizes. And then when that smart contract is accepted and the payment's delivered, if for any reason that lumber arrives and it's not the right kind, contrary to what happens a lot of U.S. ports, which will accept it and just discount it, it's rejected. The payment is then returned to the sender, and the person providing the goods has to provide the right goods before that payment is returned. And that's all governed by smart contracts. That's what atomic settlement means here. It says the simulated ledger network enabled atomic settlement, meaning both sides of simulated transactions were settled either simultaneously or not at all. This greatly reduces the various aforementioned risks that counterparties incur in current state environment, meaning how do you know that that contract was all the parts of that contract were met at the time payment was made? That's what they want to do with atomic payment smart contracts and central bank digital currencies. Think of the smart contract as the contract, the digital currency as the payment, and the system itself an instantaneous settlement. So instead of saying buying real estate and going to the title office to close and bringing a check and all that stuff, it's all happening in real time. It's going to help facilitate faster worldwide trade. And it's going to link the central bank digital currencies of the world with world trade until we have a fully functioning system, all developed together at the same time. This offers an incredible amount of control over worldwide trade, values of currencies, and things like that by the world central banks and the politicians. And you can only imagine what's happened to the dollar over the last 100+ years. The politicians constantly egging on the central bank to do quantitative monetary policies. This is going to happen even faster with digital currencies, in my opinion, which is why I think eventually they'll fail. A couple of fail in their current iteration, and I think people will eventually reject them when the problems become clear. However, that will take a little while, and I think they will be in play for a while. A couple of things from the IMF, lest anybody think this is all new. This has all been talked about dating back to 2015, at least from the IMF. This is a 2018 article, and here's a 2015 working paper that I'm going to go over. I just wanted to, I'm not going to go through this IMF working paper. I'm just going to read the quote. Listen to what they're saying. This is back in 2018, almost 5 years ago, 4.5 years ago. It says here, according to the IMF, quote, monetary policy remains constrained by the lower bound in many countries, limiting the policy options available to address future deflationary shocks. The existence of cash prevents central banks from cutting interest rates much below zero. That's called negative interest rates. In this paper, we consider the practical feasibility of recent proposals for decoupling cash from electronic money to achieve a negative yield on cash, which would remove the lower bound constraint on monetary policy. Translated, we want to push cash out of the system, so we're going to make cash less valuable and electronic money more valuable, so you're forced to accept it. That's what that means. We discuss how central banks could design and operate such a system and raise some unanswered questions. Then if you get into the IMF working paper in 2015, they were talking about breaking the zero lower bound. And this is work paper 15/224 IMF by Ruchir Agarwal and Miles Kimball, put forth in 2015. It's on the website here, although I'm just showing the local version of it. You can go to the IMF and look up this paper title on Google, and you'll get it right there in the first couple of search results. So again, written in 2015, as you can see the copyright. And there are just a few things I want to show you here that are very interesting. I want to show you how they're considering in this drawing there, how basically to push people out of cash and into electronic money. With paper currency, you get a cash withdrawal and electronic money reserve accounts. But when there's a negative interest rate, paper currency goes in, the central bank decrements that. So you put $100 in, say direct deposit from your employer, or somebody sends you an electronic payment wire, whatever it is, into your account. They'll decrement it by the negative interest rate and then you'll get less electronic money, which you'll then have to spend electronically. And it says account balance is reduced by negative rates. Why would they take your money right as it comes into the system and use negative interest rates? Because they need to control aggregate cash. Why do they need to control aggregate cash? One of the problems in the current system is too much debt and too much cash. And they want to be able to control that aggregate cash to prevent the business cycle from being particularly detrimental, and also being able to control monetary policy with the punch of a key on a computer versus having to do all this other stuff around getting approval from Congress to raise the debt limits and issuing more currency and the clunky system that we have now. It's just a faster way to run the system the way that they want, not necessarily to benefit you and me, but to benefit what they consider how the economy should be run. So we're moving, in other words, ladies and gentlemen, using this electronic system into more of a command and control economy, centralized by the government and the central bank. Whether or not you think that's positive, I'll leave to you guys, but that's essentially what they're doing. A couple of things that I wanted to talk about in this paper, which I found very interesting, is that there's a target rate and a PCIR, which means they think that, let's say you have a positive interest rate in the banking system of 2%, but there's too much cash in the system. How much do they need to decrement it to take out that 2%? They've got a model for that. And I just wanted to let you guys know that. They've got models for how they control money in the system and how much your money is worth with the press or the keystroke on a computer. Other artifacts that I want to tell you about, they know as a percentage of currency in circulation and nominal GDP who's using more cash. In other words, if you got to push out cash, they got to figure out who's using the cash. The euro area uses a lot of cash as a component of their GDP every year, meaning people use cash a lot, less credit cards and less other forms of electronic payment than do other countries. You can see here, Switzerland is the highest. Then you have countries like Norway. And then down here, you have the UK, and the US is down here. In the US, we use a lot of electronic transactions, mostly through credit cards and wires and PayPal and stuff. So we're going to be the easiest to get into this new central bank digital system because we use less cash than just about everybody else. The Euro area, Norway, Switzerland, to some extent, Australia a little bit, are more users of regular cash, and it's going to take longer to get those people into that system. They know this, and that's what I wanted to point out. Also, they're talking about cash and payment card usage and which countries use more cash, debit, credit, and other. So they know exactly who they have to target to get people into electronic payment systems. By the way, as I end the screen share and wrap up with final notes, they're okay with you having credit cards because a credit card can be attached to a bank and an account which uses central bank digital currencies. So the beauty of the way they've set up central bank digital currencies is they don't have to change anything with your bank account or your credit cards. All they have to do is push out the private cryptos and push out competitors like Venmo and PayPal and Cash App, which the banking system is already doing, claiming that a lot of those are facilitating underground transactions or some sort of illicit transactions. They're going to push out those alternatives, and they're basically going to force the central bank digital currencies upon us. And that's the way that they're going to manage the system. It is central planning. That's essentially what it is. Whether it's good or bad, I'll leave to the viewer to decide, but I wanted to point it out. What's the point of all this and putting this on a gold and silver focused channel? Well, it's because gold and silver are going to be your only alternatives. I do not believe that the cryptocurrencies right now, including Bitcoin, Ethereum, Monero, all of those are going to be allowed by the government to be true competitors. They're going to put limits on them. I do believe that you can use them right now. Certainly, if you have some of those, it's a way outside the current system for transacting value that's not illegal. It's currently legal. But I do think that there are so many problems with that system that it's not being adopted for the most part by people. Only about 10 to 15% of transactions are of a monetary nature. The rest are speculative. So people are just getting in to make money and trading Bitcoin and Ethereum and all that, but they're not actually using it as money. So I think people haven't adopted the private cryptos. They're going to be forced to adopt the central bank digital currencies. And so really what that leaves is the only viable alternative on an everyday basis right now is gold and silver. It doesn't mean people can't adopt Bitcoin, but a lot of people won't, especially the older crowd. And essentially what you'll have is adoption of gold and silver as a private bartering and trading mechanism in the meantime, or as a store of value while the dollar eventually dies and the issue in the new system and all of that period of uncertainty that we're going to have as we transition to this new monetary system. It makes sense to hold a little bit of gold and silver in your portfolio to offset that risk and give yourself away. Worst case scenario, if we have bank closures and the new system's not working, there are glitches, to go down and trade for some bread and eggs if you absolutely have to, or for services, or to get gas. I don't know if that will come about, but that's definitely a possibility. I do think the government's going to work overtime to make sure the CBDC systems are operable before they push them out into the world, because I think every political and financial policy that they want to implement is going to, in the future, is going to depend upon this functioning system and its replacement for the fiat dollar, the paper dollar. But I do think that best laid plans means that there could be some screw ups along the way. So certainly having the precious metals, in your portfolio could definitely help address some of that currency system risk that we're going to see over the next few years. All right, that's going to do it for today. Thank you so much for tuning in to the JM Bullion channel. And thank you for being an avid follower and customer of the company. We certainly love them, and we certainly like contributing this information as well. Thank you for watching. Until next time, this is Rob Kientz for Gold Silver Pros and JM